Mr. Toastmaster, fellow Toastmasters, and most welcome guests. Financial priorities change with every age and stage of life. Someone that's fresh out of college wants to get rid of their crippling student debt potentially, and that's going to be their focus. A newly married couple may be looking to buy a house, and that's going to be their focus. If they've just had a child, then all of their focus is now directed to their children. And typically, it isn't until age 45, 50, 55, 60, maybe even 65, when a couple no longer has to worry about other people, that they begin to focus on themselves and start thinking about the possibility of retirement and how to plan and structure for that. And just as the financial needs change with age and stage of life, so too does the strategy that needs to be implemented in order to achieve that objective. So in retirement, what's really important is income. You don't want to have one month that is a $5,000 income month and another month that's $8,000, another month that's $3,000. You can't really plan a lifestyle around that. So someone that's young can afford to be in the market and go up and down and wait it out. And in the long run, it's always proven that it will go up as long as it's, certain things are being done right. But in retirement, that's different. So my purpose today is just to share with you 3 ideas that I believe are the absolute key ideas in order to create a retirement that is incredible, is fun, that is stress-free, and going into much deep because of the time constraints. I'll give you the big picture, the one key takeaway. And then if you would like more information, I have created some free tools on my website, grow.ca/retirement, where you can go in and read in detail about any one of these concepts. So the first one is to seek consistent. And I gave you the example of the stock market and the ups and downs there. Another example would be if you were invested in land and you bought a piece of land for $50,000 and it became $1 million by the time you were ready for retirement. It's still not all that useful to you because it's not generating income. So until you sell it and figure out how to generate income with it, it's not really all that useful. So another tool that, or a set of tools that somebody that's in that stage of life might consider is obviously there's different types of stocks, and there's some stocks that pay dividends. So a dividend is basically a profit share paid back to the investor for owning a stock in that company. Another tool would be one that's provided by insurance companies called an annuity. And that's also a consistent income that can be planned for and set up. Another one of my favorites is in the private real estate area, and it's what's called a mortgage investment corporation. So just the same as banks go out and lend money to individual investors, to individual homeowners, there are specialized niche organizations that go out and lend money to, say, a commercial borrower or to a builder. There's a few specialized niches where the interest rate is higher, and that can then be passed on to the investor. And the more important piece there is that it's a consistent rate of return. So you're not having to guess what your lifestyle is going to be the following year because you don't know what the market's going to do, and nobody can predict what the market's going to do. So that's tip number 1. And again, if you want more information, growyourwealth.ca/retirement. Tip number 2 is to focus on optimizing your taxes. So if you've ever received a salary, you know that 100% of it is taxable. That's the same with something like a GIC or rental income. 100% of it is taxable. So they're not extremely efficient ways of investing from a tax perspective, because what you have left after you've paid the government is lower than what it could be. So some other tools that I might suggest you research and learn about, what's called a REIT, a real estate investment trust. So it's a big term, but really if you know what a rental property is, you can understand what a REIT is. A REIT is simply a professionally managed group of rental properties, and typically they're either, say, a group of apartment buildings, so now you have 5,000 doors instead of one, and your money is pooled in with other investors, so you're getting, your risk is also diversified across multiple properties. So if there's a flood in one property, it doesn't mean that your entire retirement portfolio is going to go out the window. You've diversified your risk through utilizing a tool such as a REIT. So that's number 2, optimize your taxes. And the thing about REITs that optimize taxes are when you get a return from a good REIT, it comes out in the form of what's called the return of capital. So there's different types of returns. There's interest, there's dividends, there's return of capital, and returns of capitals are highly tax efficient because it's exactly that. You got some of the money that you put in back out. And if you got your money back, you don't typically get taxed on it because you've already paid the tax previously. So just something to think about. Most investors in Canada aren't aware that these tools exist, and that's partly the purpose here. And if you'd like more information, it's available on my site. Or if you just Google it, there's lots of information as well. The third tool or tip for investors going into their retirement is to get a financial advisor who is not a salesperson, but who is rather a fiduciary. Now, if you think of, to explain what a fiduciary means, you think of the relationship between a doctor and the patient. You expect a certain level of care and duty of care from a doctor because they are highly qualified, they're in a position of where the client relies on, or the patient relies on the doctor. Now, the investment industry isn't necessarily set up like that. In fact, I'd say 95+% of the industry is set up on a commission basis. So that's the easy way to tell. I'm using some terminology, but the really easy way to tell is how is the investment advisor being compensated. If they're being compensated primarily on a commission or a trailer basis, and you don't really have full transparency on what the compensation is, or you don't have a defined, this is what you get in exchange, like this is a service you get in exchange for what you're paying, then chances are you're not working with a fiduciary. And again, the difference between somebody that's in that suitability standard versus in the fiduciary standard is that more is expected of the fiduciary standard. They cannot make decisions based on how much compensation they're getting, whereas in the suitability standard, they can do that. So they just have to make sure that, yeah, your risk profile matches the investment. That's not a very high standard to have to follow, and there's definitely lots of great people in my industry. I'm not knocking the industry in any way, but when you do hire a fiduciary, you know what you're getting, and there's a good chance you avoid, or there's a 100% chance you avoid the risk that you could or would be taking otherwise. So again, more information is available on growyourwealth.ca. Just to recap, the 3 tips then are: the first one, to seek investments that generate consistent income. Number 2, to optimize your taxes more effectively. So if you're paying anywhere more than, say, 15% or 20% net taxes, there's probably more, not in all cases, but there's lots of legal ways in Canada that the wealthy use that there's no reason that everybody else shouldn't be using, the fact that they haven't paid anybody for the advice. And number 3, don't get a salesperson, get a fiduciary. So adopting any one of these changes will have a tremendous impact on your financial future, and I hope I've added enough value here that you can take that away and do so on your own. And certainly if you're looking to learn more, there's just some resources on the site, growyourwealth.ca/. You're welcome to go and download.